Well, in addition to the sell-off that we have seen in the equity market, there's also been a pretty significant one in the bond market. That seems to be continuing unabated. We're looking at the yield of a U.S. 10-year now hitting back to those levels not seen since 2007, before Lehman Brothers crash. Rihanna was still making music. Times were different back then, but is this time going to be different with respect to what it means for the equity market? Let's bring in Eddy Gifford. He's wealth advisor at TACTIP. Today, Eddy, we are seeing markets resilient in the face of that continued sell-off in the Treasury market. How are you thinking about the action that we're seeing in bonds?
Well, the bond market typically drives everything else. The Fed typically follows the bond market. The stock market typically follows the bond market. We saw 2022 really get beat up because of the bond market. And so we always have to pay attention, and we need to figure out, is the bond market telling us something that we need to be aware of? And when you look at it, you see treasuries really kind of failing from a price standpoint against high yields. And so that, generally speaking, tells us that this is kind of more of a risk-on environment. Until that flips, we're not really running for the hills, so to speak. We think that there's still potentially some upside in the market. Generally speaking, the stock market does go up when interest rates are higher. It's just we had this dramatic move over the last 12 to 18 months that has really kind of caught a lot of us on our heels, and we're kind of adjusting to it now. So the bond market matters, and right now it's still kind of telling us that there's probably a little bit more upside for the markets. But when you take that into account with everything else out there, it's hard not to at least be a little bit nervous.
Okay, so help me understand this. It seems like you're I don't know if you're a bull in bear's clothing or sort of the opposite. You're worried, but you're staying invested.
Yeah, I think that, at this point, if I'm looking at it from a portfolio construction standpoint, this is where I'm adding the hedges. Like I think that we do have upside. I never want to not be invested, because that's kind of the worst thing, right? You're not invested, you watch the market run away on you, and you're like, oh my goodness, I missed it. So, this is a time where we're looking at least kind of adding some protection to the portfolio, but we're not running away. We think that there's upside. We've got NVIDIA reporting coming up. We've got Best Buy and Lowe's coming up. And so, we're kind of watching those to get a pulse on what the consumer is looking like. And the other thing is that we've got Toll Brothers coming up. And so, still kind of seeing, hey, is that builder market still strong out here?
Okay, let's unpack some of these movers, because we are seeing NVIDIA trade up into earnings. I mean, this seems like a very obvious, dangerous setup. Expectations are very high. Multiples are very high. I don't see how NVIDIA could deliver anything at where expectations are that wouldn't prompt a sell-off.
Yeah, I mean, you look at it, and I think that NVIDIA has been kind of the crux of the market for the last. So we saw things were kind of waning. Things weren't doing so good. And then NVIDIA came out last quarter and jumped 25% overnight. And, guess what followed? The semiconductor space, the technology space, the Qs, everything just kind of ramped up. And now we're to this next spot of the year where, generally speaking, August and September are kind of scary months. It seems like if something happens, it's usually around then. And so if they don't have, stellar earnings, I mean, it wouldn't be surprising to see it drop back down to $300 a share. Now, obviously, if somehow they can come through, we could see 500. I don't know about a double, like what some analysts are saying, but we could see 500. But I still think that we're stretched there. I still think that we're kind of on the top end of a lot of things right now. And, I still think that if we're looking out over the next 12 to 18 months, there's probably more downside than upside potential, unfortunately.
Okay, so how do you deal with that? Do you short it? Do you buy? Do you go into the option space? Do you just take your wins and put that money elsewhere?
I think that a lot of it comes down to trade management. And so as you're investing, you should kind of have predetermined profit targets and stops in place. And so in the event that we hit like these new higher levels, we would potentially take profits, like on NVIDIA, for example. If we get above 450, we're going to take some profits. And then if the market decides to change its mind and fall, then we have stops in place. Shorting is dangerous. It's never really worked like consistently long term. Sure, you can get lucky sometimes. I'm a Las Vegas boy. There's gamblers that go out there and they get lucky sometimes, but the house wins most of the time, right? And I think that that's the same thing when it comes to shorting. So I would stay away from shorting. Usually I would say, hey, like we should look at treasuries as a defensive component, but as long as the inflation story stays out there and rates stay elevated, I think that jumping into treasuries is still kind of dangerous. I would rather be early to the party than late to the party in a flight to safety scenario. But if you jumped into treasuries, a month ago, you're down over 10%, and that's supposed to be like you're a safe trade. So I think that trade management right now is the key. Maybe implementing a few hedges, but really just kind of, it's okay to take some money off the table, because that same treasury story on the other side is, hey, short-term treasuries are paying over 5%. We can get paid to wait for once because that hasn't happened in the last 15 years.
You mentioned Toll Brothers, which stands in stark contrast. NVIDIA is a 50 times earnings story. Toll Brothers is a 7 times earnings story, right. but is trading close to an all-time high. And the housing market has been a really interesting play. On one hand, you've got these home builders that have rallied so much, and the home improvement stocks like Home Depot, Lowe's have not fared well because they're a little bit more sensitive to, consumer slowdown.
Exactly. And I think that, in a way, you can almost say, well, the builders are cheating. And what I mean by that is that there's, especially in the United States, there's so many people that are locked into 30-year 3% mortgages. And so they're not moving unless they have to. They get an excellent job offer somewhere else or anything like that. But even if they're moving, a lot of them are choosing to rent their places because they can cash flow positive or be cash flow positive immediately because the rate and payment is so low. And so then it comes down to, okay, well, where's the market at? Well, that means the market is only in builders. And the builders are smart. They're using, a lot of them own mortgage companies, and so they're able to offer incentives to bring the mortgage rates down below market. And so the consumer feels like they're getting a deal when they're buying a house, even though we know that housing valuations are super, super high. So until that kind of corrects itself, we think that builders still have upside potential. They're buying lumber at lower prices than they were a year ago. And so they can potentially kind of build in a little bit more profit to the build itself. So it's interesting to look at how polarizing the dynamic is. We think that this probably does end badly for housing over the next 24 to 36 months. But as of right now, what we've learned this year, especially with NVIDIA, is don't run away from a stock just because it's going up. It could potentially go a lot more, especially just as fast as the market moves today compared to 15, 20 years ago.
What about the opposite? Run away from a stock that's going down. That's been the trade for Tesla recently over the past month. It's gaining today as an analyst kind of pounds the table on other stuff. It's not just price cuts. It's not just margins. There's Cybertruck. There's AI, which I don't know what that looks like. Maybe you do. Eddy, what do you think of Tesla?
Well, Tesla is one of those stocks where it's hard to run away from, like long term. I think that, if you look at what happened to it last December, it was down almost 60%, and then it just rallied like this entire year, and now it's kind of pulling back again. We know when you're buying Tesla, you're going for a ride, right? This is the roller coaster that goes up and down and bounces around like a ping pong ball. But I think long term, it's a buy. I think short term, I think that everything right now is dangerous short term. So you have to make sure that if you're going to buy it, put a stop, 10 to 15% below what you bought it at, and be disciplined. If it hits that, get out, go find something else. If things roll over and we see the market go down 30, 40% again, like we did during the financial crisis, there's going to be a lot of values. You're going to be happy that you have some dry powder in that situation to pick up stuff on sale. So knowing that we're kind of near tops in the markets, there's nothing wrong with having a little bit of dry powder. You can take your chances, but make sure you're disciplined when you're doing so.